Hello, and welcome to episode 12 of the Life and Finances Together podcast. We want to thank our audience members who have liked and subscribed and encourage you to make that click today if you haven't already. On today's episode, our financial professionals, Roger David and Jake Reinfeldt, will be breaking down the topic of risk-adjusted return for us and sharing why it's a valuable component of a financial plan. We're excited to get started, so Roger, I'll turn it over to you.
Well, let's get started in 2025, right? We're excited for a new year, but one of the things that kind of gets missed regardless of the year, regardless of the performance of what the market's done, is this thing called risk-adjusted return. Now, that sounds really technical. Sounds like you're going to be managing portfolios here soon once we get that understanding of what this is. But this is what people miss the most, right? Everybody looks at the S&P 500. We're all conditioned to look at this S&P 500. You're all quoted on it. Everybody's looking at it. And the unfortunate part in our business is advisors as well as clients are always benchmarking themselves against the S&P 500. Well, that might be okay if you're 21 or 22 years old and just coming out of college. But when you're retired, the odds are you're not going to be investing your entire nest egg 100% into the stock market. So looking at what the return is on the S&P 500 is probably an unfair and unrealistic comparison. And one of the things when we look at the S&P 500 is, man, it is really at some point kind of skewed either to the upside or the downside. When we look at the S&P 500, that index that you're all quoted on, everybody's familiar with, you see it on the news, you hear it on the radio. Well, it's what we call a cap-weighted index. So here we go. We're going to get technical on you. All that means is this. The larger the company, when we multiply the number of shares times the share price, right? Whatever that value is, the larger that value, the more influence or the more weighting it has in the calculation of the return on the S&P 500. Well, that's kind of unfair because when we look at the S&P, the 12 largest stocks of the S&P 500, and there's 503 stocks in the S&P 500, right? Those 12 stocks represent over 38% of the weighting, meaning they represent 38% of the return calculation on that index. Well, most people are not going to put 38% of their nest egg in 12 stocks. That's just not going to happen. So if you're just saying, hey, look, I'm going to do the Vanguard 500 index fund, well, understand what you're buying. It all looks good when markets are going up, but it could be a problem. Remember, 12 stocks represent 38% of the return calculation on the S&P 500. I mean, when you look at that and say, hey, do I really want to do that? No. One of the things that we look at is we look at the S&P 500 equal weighted. And what that means is we're not looking at what the value is of the stock. When we're looking at the share price multiplied by the number of shares outstanding in the market, we're just giving an equal weighting to the 503 companies in the S&P. And we're simply doing a simple average, right, of the S&P 500 and those 503 companies. When you look at the chart, you're going to see that there's a big discrepancy there as far as the returns on the 1, 3, 5, and 10-year number. Why? Because of that weighting on the S&P 500 that you're all quoted on, the one that's used all the time. A more accurate depiction, which is more accurate of what you're doing in your portfolio, because what do? We rebalance portfolios. Right? If you have too much weighting in a certain stock or a certain investment, what do? You rebalance to make sure you're pulling your portfolio back in line with what the risk is, right? But if you look at that discrepancy between the S&P 500, the regular index, and the S&P 500 equal weighted, man, there's a big difference there. And depending on what you're looking at, you're going to be unbelievably happy or maybe unbelievably disappointed. So need to understand first, what are you comparing it to? And what's inside? Peel back the onion of the index that you're looking at. Peel back that onion and say, hey, I want to see what this is really calculating. Now, one of the other things that we've had a problem with, I don't want to say a problem, but a challenge with, really in the last 3 to 5 years, has been the bond market. I mean, Jake and I have just been going crazy waiting for this bond market to turn. And there's an anomaly here that we've seen, right? Jake's, been in the business for 10 years. He's got to see every bad thing that's kind of gone on. But one of the bad things is the bond market here, right?
Yeah, when you're talking about risk-adjusted return, what we're saying is you need to understand how your portfolio is allocated. Because unless you're younger, like Roger mentioned earlier, you're not going to be 100% stocks. So your portfolio is going to be made up of primarily a mix of stocks and bonds. And understanding that mix is really determining how much risk you have, and then you compare that to your portfolio for risk-adjusted return. Well, a huge lag on portfolios for all of our clients and pretty much everyone in our industry has been that bond market. I mean, since the previous high that we saw in the bond market on August 3rd of 2021, we've not only not come close to recovering in that time period, the bond market is still down about 8.25% through the end of last year.
That's over how many? How long is that? That's over 3 years, right?
Yeah,
a little
exactly.
over 3 years.
So that's a 3-year period in which the bond market has gotten absolutely creamed because of rising inflation, rising interest rates, both of which are negative on bond values. And we have not had an environment where it started its recovery yet. We had it somewhat in 2024, then it came back down. So much is tied to what the Fed is going to do and how they're going to cut rates. And it's one of the biggest things that you have to keep in mind when you're looking at your portfolio performance, especially if you're a retiree. Bonds can be anywhere from 40 to 60, if not higher, in terms of a percentage of your portfolio allocation. And it's an asset class that, unfortunately, has not performed very well.
It's been terrible. It's been the worst we've ever seen, pretty much in the bond market ever.
Yeah.
Right? Stocks recovered faster than the bond market recovered.
Yeah, exactly. And it's historically the worst period we've ever seen in terms of bond market performance. And it's something where we know the recovery is coming. It's not a question of if, it's a question of when. And unfortunately, that goalpost is continually getting moved, and a lot of it, again, is tied to what the Fed is going to do. Because as rates drop, bond values will rise. And we understand that correlation, that negative correlation. That's just how bonds work. They're very mathematic.
Yeah, it's a teeter-totter.
In that sense, yeah,
What it
exactly.
is, right?
It's a teeter-totter. Well, when we hear that we're not going to get as many rate cuts as we thought we would in 2025, you start to wonder, hey, how is the bond market going to perform?
Right.
Because so much of it is tied to that. So you have to understand that this bond market has been a lag on performance, and we're still waiting for that recovery. But when the environment is better, we do anticipate we're going to get some good performance out of the bonds because they're still so far off their previous high.
Right. And the Fed's only begun to cut interest rates. I mean, so, Jake, I'm going to ask you the question that clients always ask us. Why are you going to put me in bonds, Jake? Why are we going to have some bonds? Why don't we get out of those bonds? What are you doing, right?
Yeah, exactly. Bonds are not an exciting part of a portfolio, right? They never have been and they never will be. They're what we refer to as a ballast to your portfolio. They're a safety net. And you can counter argue and say, well, a safety net, bonds were down about 17% from their previous high to their previous low. And we will say, well, that's an anomaly. It's the worst bond market we've ever seen. But we always need to keep a portion of your portfolio in bonds or fixed income because it is a safety play, right? It is a safety net. It generates income for you as well inside of your portfolio. But it always needs to be a part, even if it is underperforming currently, because we can't, in turn, just take all that allocation and put it in stocks. It's going to be way too risky, especially for our retirees.
Yeah, I mean, they say this is the worst bond market since the 1850s. Mm-hmm. I don't know what they were doing in the 1850s. I was like 4 guys in Chicago changing paper on a wood desk. Yeah, here's my bond. Here's your bond. There we go. Hey, look at the trade we just did. I mean, they tell us these things. You're kind of like, really? 1850? Was there anybody in the room? Did they have a camera? No, they had no camera. There was nothing. I don't even know how the heck they even remember that. Were they even keeping track of those things? But when you look at this, I mean, it has to be like Jake had said. It's got to be part of the portfolio. So I mean, when you look at one of the things that it does, I mean, when we look at putting together like an example that we have in the chart, the 60-40 portfolio, I mean, it's designed to do what? It's designed to just kind of streamline it, reduce some of the volatility.
Yep, exactly. That's exactly what it's for. And we preach here at Ryan Belton David diversification. You want to have an allocation in a portfolio that is appropriate for whatever your risk tolerance is, your time horizon. But you also want to be diversified. So you're going to be invested in bonds, stocks, different types of each. What you'll see in the chart is just a kind of generic 60-40 portfolio. But what you need to see is that doing so, creating a portfolio that is not 100% stocks, not 100% bonds, but is more diversified and has that sort of allocation, does smooth out your ride.
Right, exactly.
Right? It smooths out the ride, and that's exactly what we want to accomplish.
Best way to put it.
You're not making a big bet on one company, one industry, one asset class. You want to be invested differently. And a big thing that we do, especially with our retirees as well, is along with stocks and bonds in a 60/40 portfolio, is managing the cash inside of the portfolio in those retirement years. So it does show, and the proof's in the pudding when you look at the charts, that you want to be diversified. You want to be diversified. You want to be spread out amongst different things.
Yeah, and you don't want to chase returns, right? So we'll sit down with clients, and I kind of always used to say that to a client that every time you come in the office, you're going to be upset with us about something, right? And I think that's the actual formal definition of diversification. A client who's investing is going to be upset about something every time they come in and meet with their advisor. But you're going to want to have that. I mean, you look at the other chart, this little colorful chart that's up there called the Callan chart, and it just shows the performance of the different asset classes, right? Large cap growth, or large cap stocks, I should say, 3 out of the last 5 years have been at the top. Right. So every year we're looking at the end of the year and say, hey, what was the best? And you know what most investors do? They're going to say, well, I want more of that. But if you look at that chart, in a lot of cases, that one that was at the top at the end of 1 year, the following year, not at the top, right? Maybe not even close to the top. So you look at the chart and you kind of see where this 60/40 portfolio goes, and you can see, man, that really streamlines it out, right? We call it an all-weather portfolio. Right, you've got something in your portfolio for any kind of weather that we're going to experience. Right, market up, market down, interest rates higher, inflation lower, whatever it is. We're going into recession, earnings are down, companies are not making as much money. Whatever the case may be, we're trying to structure an all-weather portfolio, which is what most smart investors are going to do. They're going to say, look, I don't know when these things are going to change. Jake and I have no idea. Right, if he knew, I'd turn it all over to him. We'd have billions of dollars under management. Nobody would be doing any investing other than with Roger and Jake, right? I mean, that's what we would want. But when you're looking at that chart, look at the shift. Look at the shift of the different asset classes from year to year. Anybody that says that they know when it's going to happen, they don't know. They have no idea. We have no idea. You can look at charts, you can look at data, you can look at everything. You have no idea because there's so many other things that are involved in what will affect the markets and the economy, right? So when you look at the black squares on that chart, you're kind of looking at that 60/40 portfolio. And if you look at it, it's never at the top, but it's never at the bottom. It's kind of streamlining and smoothing things out, because you just don't know. Jake mentioned it perfectly just a second ago, right? Managing cash, right? What's the one thing we're most concerned about all the time? We don't want to do what? We don't want to withdraw.
When the markets are down.
That's right. We don't want to withdraw when the markets are down. So what do?
Manage cash.
Yeah. We're always got something in the portfolio where especially for people who are retired and taking withdrawals. The worst thing that we can do, and the worst thing that anyone can do in their portfolio, is have to take a withdrawal from the portfolio that's down. So what does that mean? That means you got to have something designated within a certain asset class that's going to have very little fluctuation, if no fluctuation at all. And that's where you take your withdrawals from. And that's where we talk about managing cash. So when you're talking about returns, don't get caught up in what your neighbor's talking about over the fence or at a barbecue, right? Don't get caught up in, hey, the latest Bitcoin trade and those types of things. In most cases, it's not going to apply to you and it's not going to be right. What's the one thing that we always say? Go back to your financial plan, right? That's the most important part in all this. You're looking at your financial plan. That's your benchmark. That financial plan's your benchmark, not the S&P 500, not the aggregate bond index or the international stock indices. No, your financial plan is your benchmark. And if there's assumed rate of return and a certain level of risk that we've adopted in that plan, well, hey, let's stick to it. Doesn't mean that we can't make adjustments. We can. But you don't want to be jumping all over the place like in that colorful chart, chasing returns. Because again, whatever was hot in 1 year is probably not going to be hot in the following year. And that's got to be part of your financial plan. You've got to revisit that. You've got to rebalance. You've got to make sure that you have the most appropriate level of risk possible. I mean, we've all heard the story about Mike Tyson, right? You know the story?
You tell it.
Yeah. Right. I
don't know.
So Mike Tyson, right? He says everybody's got a game plan.
Oh, yeah.
Everybody's got a game plan. Right?
They get punched in the face.
Until they get punched in the face. They know exactly what they're going to do. They know exactly how they're going to carry out the fight. And then they take one to the chin. And all of a sudden, what are you thinking? Get me out of here. Right? I got to start making some changes all of a sudden. Well, when you do that, what happens? A lot of times in the fight, they lose. right? Because you abandoned what your game plan was. You abandoned all the prep that you have taken up to that point. And that's what we're talking about. Understand what the returns are in the market, but understand what the risk-adjusted return is in your portfolio based upon your time horizon, based upon your risk tolerance, and based on what your needs are, right? And one thing, too, is make sure you are holding cash to take withdrawals, especially if you're retired. Number one thing, the biggest mistakes you can make are consistently taking withdrawals out of a portfolio that are down, where you didn't have a certain portion of the portfolio that wouldn't go down when markets fluctuate. So that's risk-adjusted return. It's an important part of anybody's portfolio.
Yeah, definitely.
So if you're looking at what happened in 2024 and you're a little uncertain, get with your advisor. Get with somebody to talk about what's the level of risk that we adopted, right? What's the return that we earned? And is it in line with the risk that we took? If the market's up 10 and you're up 5, well, in simplest terms, we'd say you took 50% of the risk of the market in the portfolio you designed. You should be happy, not upset. You took out an appropriate level of risk. You're an appropriate level of rate of return. That's what we're talking about with risk-adjusted return. It kind of is that simple. There's more that goes into it, but make sure you're just staying on top of that. That's the important part.
Thanks so much for watching, for listening, and for learning about risk-adjusted return with us today. For questions about our financial services or finances in general, please check out our website, that's reinveltdavid.com. Send us an email, give us a call, and of course, please like and subscribe to our podcast and stay tuned for our next episode.
This podcast is for entertainment and educational purposes only and is not intended as personal financial advice. Before making any financial decision, please do your own research and consult a financial advisor as needed.